Friday the 13th, 2026. While most people worried about bad luck, something far more significant happened in the silver market that nobody saw coming. In Dubai, physical silver bars traded at $127 per ounce. At the same exact moment, COMEX paper contracts showed $73. That's a 70% price gap. This wasn't a glitch. This wasn't market noise. This was the beginning of something the financial system has been desperately trying to hide for decades. And if you think this story is over, you haven't been paying attention to what happened next. Let me take you back to what actually happened on January 13th. The mainstream media wants you to believe this was just another volatile trading day. They want you to think the spike was temporary, that markets corrected themselves and everything returned to normal. But here's what they're not showing you in those headlines. On that Monday morning, traders in New York woke up to COMEX silver futures trading around $73. This was already historically high. The previous record was broken weeks earlier. But seasoned traders knew something was different this time. The physical market wasn't following the paper market anymore. In Dubai, the world's critical hub for physical precious metals trading, buyers were paying $127 cash for actual silver bars. Not promises, not contracts. Real metal you could hold in your hands. This created a price disconnect that should be impossible in efficient markets. Economics textbooks tell us arbitrage opportunities like this get eliminated within minutes. Buy low in New York, sell high in Dubai, collect the difference. Simple, right? Except it wasn't happening. And that tells you everything about what's really going on. The COMEX is supposed to be the global price discovery mechanism for silver. When you see silver prices on financial news, they're showing you COMEX futures prices. The entire world's silver market supposedly takes its cue from these paper contracts, traded in New York, but on Friday the 13th, that system broke down in plain sight. Here's what actually matters. The COMEX operates on a fractional reserve system for precious metals. They don't have enough physical silver to cover all the paper contracts they've sold. Everyone in the industry knows this. It's been an open secret for years. The system works as long as most contract holders settle in cash, instead of demanding physical delivery. But something changed in January 2026. The demand for physical delivery started overwhelming the system. COMEX registered silver inventories. The metal actually available for delivery dropped to levels not seen in decades. We're talking about inventory drawdowns of 40% in just 3 months. Major banks that usually defend these price levels with unlimited paper selling suddenly went quiet. Let me give you the numbers that matter. In December 2025, COMEX registered silver inventory stood at approximately 45 million ounces. By mid-January 2026, it had fallen to barely 27 million ounces. Meanwhile, open interest in silver futures remained near all-time highs. The math doesn't work. There's simply not enough physical metal to satisfy potential delivery demands. Now here's where it connects to Dubai. The Middle East has become the physical settlement hub for east-west silver flows. When Asian buyers want physical metal, they don't trust COMEX delivery. They go to Dubai. When European refiners need to move metal quickly, Dubai. When wealthy families want to convert paper wealth into tangible assets away from Western banking surveillance, Dubai. On January 13th, the Dubai premium over COMEX wasn't just about supply and demand in one market. It reflected a complete breakdown in confidence in the paper pricing system. Buyers were willing to pay $54 more per ounce, a 74% premium, just to get real metal in their hands immediately. Think about what that means. In normal markets, price differences of even 2 or 3% trigger massive arbitrage flows. Professional traders borrow money, move metal, and pocket the difference. It's free money. But a 74% gap that persists for hours? That's not a market inefficiency. That's a market screaming that the paper system has lost credibility. The Federal Reserve's role in this cannot be ignored. For months leading up to January, Fed officials kept insisting inflation was under control. They pointed to official CPI numbers showing modest price increases, but anyone buying actual goods knew better. And more importantly, anyone trying to buy physical precious metals knew the real story. Let me explain the China factor that nobody's properly connecting to Friday the 13th. This is where the whole story really starts to make sense, and it's what separates people who understand what's coming from those who think this was just a temporary spike. China controls approximately 70% of the world's refined silver production capacity. Not mining, refined production. This is crucial. You can mine silver ore anywhere, but turning that ore into the pure metal that industry actually needs requires specialized refineries. And China built most of them over the past 2 decades. In late 2024, Beijing quietly changed export regulations on what they classified as critical minerals. Silver fell into this category. They didn't ban exports outright. That would be too obvious and would trigger immediate international response. Instead, they implemented a licensing system. Exporters now need government approval for shipments. Processing times became unpredictable. Quotas appeared without official announcement. By January 2026, the impact became impossible to ignore. Western industrial consumers who relied on Chinese refined silver faced delays of 8 to 12 weeks for deliveries that previously took 2 weeks. Some orders simply never got approved. The licenses would sit in bureaucratic limbo while spot prices climbed. Here's what makes this different from typical supply disruptions. China isn't experiencing a production problem. Their refineries are running. Their mines are operating. The metal exists, but it's staying within Chinese borders, or going to countries Beijing considers strategic partners. The Belt and Road nations are getting their silver. Western companies are getting excuses. This created the perfect setup for what happened on Friday the 13th. COMEX is primarily a Western institution. The major banks that provide liquidity are American and European. When they sell paper silver contracts, they're making a bet they can source physical metal if needed. For decades, that meant calling Chinese refiners and placing an order. But what happens when those phone calls stop working? What happens when the refiner says, yes, we have the metal, but our export license is pending government review? The banks can't deliver. Their short positions on COMEX become naked shorts backed by nothing but hope and prayer. Now layer in the Trump administration's trade policies that took effect in early 2025, the tariffs on Chinese goods, the restrictions on technology transfers, the public statements about reshoring critical supply chains. Beijing didn't need to announce retaliation. They just quietly turned off the silver tap. American manufacturing still needs silver. Solar panel production requires it. Electronics manufacturing requires it. 5G infrastructure requires it. Electric vehicle production requires it. These industries can't just stop because China is playing supply chain games. So they started bidding up physical metal anywhere they could find it. The solar industry alone consumed roughly 140 million ounces of silver in 2025. That's projected to grow to 185 million ounces in 2026 as renewable energy mandates kick in across multiple countries. Where is that silver supposed to come from if China controls refining and they're restricting exports? Mexico is the world's largest silver mining country, producing about 190 million ounces annually. But Mexican mines send their concentrate to Chinese refineries for processing. The refined metal then needs to come back, except now it's not coming back in the quantities needed. Mexico is exploring building domestic refining capacity, but that takes years and billions in investment. Peru, the second largest producer, faces the same problem. Their mining output is strong, but refining capacity is limited. They're dependent on the same Chinese facilities that are now operating under export restrictions. This is why the Dubai price matters so much. The Middle East became the pressure release valve for this supply crisis. Refiners in Switzerland, the traditional neutral ground for precious metals, started diverting output to Dubai instead of London or New York. Why? Because Dubai buyers were paying cash premiums with no questions asked. On January 13th, that premium reached its peak. Industrial consumers desperate for physical metal competed with investment buyers trying to get out of paper positions. The result was $127 silver in spot transactions, while COMEX still showed $73. Think about the implications. If you're a solar panel manufacturer and you need 50,000 ounces of silver for next month's production run, what do? You can buy COMEX futures at $73 and hope for delivery, or you can pay $127 in Dubai and know you'll have the metal in your factory within a week. Now we need to talk about what happened behind closed doors at the COMEX and the major banks. This is where the real manipulation shows itself, and it's why Friday the 13th represents just the beginning, not the end. The COMEX margin requirement system is supposed to protect market integrity. When volatility increases, they raise margin requirements. This means traders need to put up more cash to hold their positions. The theory is this reduces excessive speculation and stabilizes markets. But here's what actually happens when prices move against the banks. In the 2 weeks before January 13th, COMEX raised silver margin requirements 3 times. First, from $8,500 per contract to $11,000, then to $14,500. Finally, on January 10th, they pushed it to $18,000 per contract. That's a 112% increase in margin requirements in 14 days. Each silver contract represents 5,000 ounces. So when they raise margins, they're not protecting the market. They're forcing smaller traders to liquidate positions because they can't meet the new cash requirements. This creates automatic selling pressure that pushes prices down, which is exactly what the short sellers need. Here's the part that should make you angry. These margin increases don't apply equally. Major banks that are members of the exchange clearing system operate under different rules. They have portfolio margining arrangements. They can offset positions across multiple contracts. They get special treatment that retail traders and smaller institutions never receive. So when COMEX raised margins on January 10th, it hit the long side. The buyers betting on higher prices. The short sellers, predominantly major banks, didn't face the same pressure. This is market manipulation hiding in plain sight as risk management. But it didn't work this time. That's what makes Friday the 13th significant. Despite the margin increases, despite the forced liquidations, price kept climbing. Why? Because the physical market had decoupled. Paper games in New York couldn't change the fact that buyers in Dubai needed real metal and couldn't get it anywhere else. Let me show you the stop-loss cascade that happened. When COMEX silver hit $68 on January 12th, automated trading systems started triggering. Traders who set stop losses at $65 got stopped out. That selling pushed prices briefly to $64. More stop losses triggered at $63, $62, $61. Classic cascade. The banks were counting on this, creating a full collapse back to $55 range. That's their playbook. Push margins, trigger stops, create panic, cover shorts at lower prices. It's worked for years. Except on January 13th, buyers stepped in at every level. Every dip got bought immediately. Why? Because industrial consumers had finally woken up to the supply crisis. They weren't trading for profit. They needed physical metal for production. When they saw COMEX prices drop on the cascade, they didn't see risk. They saw discounts. Compared to the $120+ they knew they'd have to pay in Dubai. The open interest data tells the whole story. Normally, when prices spike and margins increase, open interest drops sharply. Traders exit positions. But in mid-January 2026, open interest barely budged. It dropped maybe 8% while prices doubled. That's almost unheard of. It means the holders of long positions weren't speculators. They were commercial buyers trying to secure physical delivery. Now here's where it gets really interesting. The major banks short on silver started requesting delivery delays, not defaults, delays. They claimed logistics issues, refinery scheduling problems, transportation complications, all very reasonable sounding excuses. But people inside the industry know what this means. When you request a delivery delay on a COMEX contract, you're admitting you don't have the metal. The contract says you'll deliver. The buyer paid for delivery, and you're asking for more time because you can't fulfill your obligation. Some of these delay requests were granted. Some buyers accepted cash settlements instead of metal, but a significant number refused. They wanted their silver. They had paid for silver. They were entitled to silver. And this created a crisis that COMEX officials are still trying to manage quietly. The inventories don't lie. Between January 13th and January 31st, another 6 million ounces left COMEX registered vaults. That's metal that was supposed to be available for delivery just disappearing. Some went to settle delayed contracts. Some got moved to eligible status, which means it's in the vault but not available for delivery anymore. Let me tell you why Friday the 13th wasn't the climax of this story. It was the opening act. And what comes next is going to make January look like a practice run. The fundamental equation hasn't changed. Global silver supply runs about 1 billion ounces annually from mining and recycling. Global demand is approaching 1.2 billion ounces when you include industrial, investment, and jewelry consumption. That's a 200 million ounce deficit. Deficits aren't new. Markets have been tight before. But two things are different now. First, China controls refining and they're restricting exports. Second, the paper market lost credibility on Friday the 13th. That credibility isn't coming back. Here's what's happening right now in February 2026. Asian central banks are quietly accumulating physical silver alongside their gold purchases. They're not announcing it. They're not publicizing it. But the metal is moving. Refiners in Switzerland report order backlogs of 16 to 20 weeks for large institutional buyers. That's 4 to 5 months. In a market that used to operate on 2-week delivery schedules. India, the world's largest consumer of physical silver for cultural and religious purposes, is facing import restrictions due to currency pressures. This is creating domestic premiums of 15 to 20% over international prices. When Indian dealers can't source metal at reasonable prices, they start looking at COMEX delivery as an option. More delivery pressure on an already strained system. The solar industry's demand curve is accelerating, not slowing. Every major economy has renewable energy mandates that require massive solar deployment through 2030. Each solar panel needs silver. There's no substitute that works at the required efficiency levels. This demand is non-negotiable and it's growing 20% year over year. Electric vehicle production creates additional silver demand in electrical contacts, circuit boards, and charging infrastructure. EV sales are projected to grow from 14 million units in 2025 to 22 million units in 2027. Each vehicle contains approximately 25 to 50 grams of silver depending on model and features. That's incremental demand of several million ounces annually just from automotive sector growth. Now add investment demand. When physical silver traded at $127 in Dubai, while COMEX showed $73, every sophisticated investor on Earth noticed. They started asking questions. Why the gap? Who's lying? Where's the real price? And most importantly, how do I position for what happens when this breaks completely? The answer is they buy physical and avoid paper, which creates exactly the pressure that caused the crisis in the first place. It's a self-reinforcing cycle. Loss of confidence in paper markets drives physical demand, which strains inventories. which causes delivery problems, which further erodes confidence in paper markets. The Federal Reserve is trapped in this dynamic. If they raise interest rates to fight inflation, they strengthen the dollar and put downward pressure on commodity prices in dollar terms. But that doesn't help if the commodity in question isn't actually available for purchase. You can't eat dollar strength. You can't manufacture solar panels with dollar strength. You need actual metal. If they cut rates or maintain current policy, real yields stay negative. When government bonds pay 4% and real inflation runs 7 to 9%, you're losing purchasing power holding cash or bonds. Hard assets become the rational choice. Silver, trading at levels still below its inflation-adjusted 1980 high of $140 to $160, looks undervalued compared to where monetary policy is pushing all real assets. The COMEX has 3 options, none of them good. First, they can keep raising margins and forcing liquidations, hoping to break the longs and defend the shorts. But this risks complete loss of market legitimacy. If they push too hard, traders will abandon COMEX entirely and do all business in physical markets. Then, New York loses its role as global price setter. Second, they can allow cash settlement of contracts that can't be physically delivered. This is probably what happens, but it destroys the fundamental premise of the futures market. If a commodity future doesn't guarantee delivery of actual commodity, it's not a future, it's just a side bet. And once that becomes obvious, the market's utility for price discovery vanishes. Third, they can facilitate actual physical delivery by sourcing metal from wherever possible, paying any premium necessary. But where's that metal supposed to come from? Chinese refiners aren't cooperating. Western mining production is already committed. Strategic reserves are limited and politically difficult to access. What you're witnessing is the slow-motion collapse of the paper-silver market's control over pricing. It took 40 years to build this system where paper contracts in New York determined the global price of a physical commodity. It's taking 40 days to watch it fall apart. Friday the 13th showed the cracks. The 70% premium in Dubai versus COMEX proved the emperor has no clothes, and every day that goes by without resolution makes more people aware of what's really happening. This information spreads, investors talk, industrial buyers adjust their strategies, and the pressure builds. This is only beginning because the structural problems haven't been solved. China still controls refining. Demand still exceeds supply. COMEX inventories are still falling. And now everyone knows the paper price is fictional. You can't put that knowledge back in the box. You can't restore confidence in a system that failed so publicly. The real question isn't whether silver prices go higher. The real question is whether we see an orderly repricing or a chaotic market failure. Either way, the people who positioned correctly before Friday the 13th and the people positioning correctly right now in February are going to be on the right side of one of the largest wealth transfers in commodity market history.